everyone, I'm Lily. I'll intro myself first, and then I'll let the panelists intro themselves as well. I am the community lead at Scroobius. We're a tech platform, also a startup based here out of Boston. And I will let John take it away now.
Gee, that was quick. Thank you, Lily. Hi, my name is John Landry. I've been in the software business in one way or another for, I'm afraid to say, about 50 years now, going back to 1972. Essentially, I've been CTO of 12 companies, including big ones, Lotus, for example, here in Boston, and did 7 startups. All of them were acquired. 6 of them successfully. One of them, my friend Joe was an investor in, so it's a little delicate to talk about that one. And then I got acquired and became CTO of the larger companies, and it's been a great run. So I did that for essentially an operating guy on the technology and product side for about 25 years, and then 25 years after that, investing in companies. I found it a lot easier to do the investment than actually be on the operations side. So it's been a great run. I'm glad to be here. I've done 45 boards of directors, 81 investments. I've had 4 or 5 unicorns. I can't remember. I think Lotus I can't count as a unicorn because it was too early, but it sold for 4.5 billion, so I thought that was pretty good. For whatever it's worth, the unicorns are Endeca, Chain Analysis, Flywire, and one other I can't remember. In any case, I've got some real strong opinions about unicorns as to whether they're a great idea or not. They're a great idea for investors. Sometimes they're not that great for the entrepreneurs that actually founded the company, but we can talk about that if we want, and that's enough about me.
Thank you, John. Thank you, Lily. Thank you, Joe. Great to be on a panel with you guys. Adam Kerr. I'm a senior partner at Mendoza Ventures, which is a fintech, cybersecurity, and AI venture capital firm located here in Boston. And we've recently expanded to San Francisco in the last month or so. So that's exciting. We're a firm that invests in early seed all the way up to Series B, Series C. We've made over 10 investments now. We have about 140 limited partners, and we are in growth mode. So it's an exciting time at Mendoza.
Hi, I'm Joe Caruso. I am probably, as I describe it, the caricature of an unfocused entrepreneur and investor. So I have no deep domain experience. I've been involved in a variety of businesses, all small companies. Never founded a company, but ran several, did turnarounds for a number of years, and for the last 20 years have been doing the kind of thing John does, but with less specialty. I've been on boards, mentoring entrepreneurs, and writing too many checks.
And Gayatri, I haven't forgotten about you. Oh, muted, I think.
First of all, I want to thank everybody, especially Stephanie and Startup Boston team, for making this technology experience very, very seamless. And I feel like as if I'm speaking at COP or World Economic Forum. That's the level of technology advance at our Startup Boston. And I highly apologize for not being there, especially with legends like John and Joe, and with our peers Adam. I'm stuck at Climate Week in New York and speaking from my Connecticut home. And I'm just excited and extremely honored to be part of this panel. And I'm very, very thankful for inviting me. A little bit about our fund is we are Advaita Capital. I'm the founder and general partner. We are 100% woman, person of color-owned fund. We invest in growth and very late stage, focusing on tech and lowering and removal of carbon. We are also an emerging manager, so we are learning a lot. A little bit about me: I'm former Goldman Sachs, former Federal Reserve Bank of Boston. I used to manage U.S. Treasuries assets for U.S. military and Navy. Also used to manage a couple of large banks. But I started my career as a data architect at Hewlett-Packard Labs and then worked for IBM. I had a more or less successful consulting company, which is a small business. And then I had a failed startup. And I think I learned a lot by doing those things. And now I'm trying to help as many entrepreneurs as possible and excited to be here.
Awesome. Thanks so much. All right, let's get into it. So for this session, we're going to talk about different ways that partners, investors can help entrepreneurs beyond the capital they provide them, and how important that is. So Joe, I'm going to throw you the first question. How important is the relationship that you establish with startup founders to your combined success?
I think it's critical. Now, I don't know if that's just my own psychology, because I know for a while I used to sit on a lot of boards, and it dawned on me several years in that the most successful companies I had been involved with were ones I was on the board. And for a brief period of time, I said, gee, that must be because I'm pretty good. And then it dawned on me, it was probably the inverse. I probably agreed to join the board only once I became convinced they were going to be successful. So my board skills had nothing to do with their success. I'm kind of getting a little bit off topic, but it was deluding myself that my involvement was a big contributor. So I don't know. I do enjoy, I would rather invest in someone who I respect and have a good relationship with and make a little bit of money than I would invest in an asshole and make a lot of money.
Very fair. And Adam, is this the same type of thing at Mendoza Ventures as well?
Relationships are really complex. I think we all understand that. It evolves at Mendoza Ventures. We communicate really at a high level with our entrepreneurs. We demand a lot from them, and they should demand a lot from us. And we are pretty open in our communication. If we're not happy, we let them know. And if they're not happy, they should let us know. So in that context, you see a lot of back and forth with some disagreements, some happy moments. But I think fostering that communication, obviously with respect revolving around it and collaboration revolving around that, I think it could get you to some really great places. So I feel there's moments in the relationships with our founders that are not ideal. But they're aware of when it's not ideal, and we're aware when it's not ideal, and we try to work to resolve that, because that conflict, that unpleasant situation is not optimal for running a business. So we try to get everyone on the tracks as quickly as we can, try to work through the issues, whether they're behavioral, poor communication skills, and get everyone on the right path. It is very important to have those moments to have people work well together, because in the end, you can have the greatest algorithm, you can have the greatest software product in the world, but if you have people that are just not being effective, you're not going to make money, and you're not going to have a great organization, and employees aren't going to be happy. So it's extremely important.
John, Gayatri, either of you want to expand on that?
I can't see Gayatri's. Gayatri, do you want to comment on that?
Please go ahead, John. Yes.
I'm sorry.
She wants you to go.
Oh,
Yes.
okay. Well, I don't know. My sense on this is, 43 boards is a lot of boards. You get to learn a lot, but a lot of those boards, I was the chairman of the board. It was my company, and I typically don't like the CEO role. It's much more fun to be the CTO and in charge of product. It's the thing that I think I actually, do best. And normally we'll partner with somebody else to be the operating person. And one case, my friend Bob Weiler, we did 4 companies together. But when you're chairman of the board in an operating company, you get to learn a lot about what you want from board members. That in turn winds up influencing me as a board member as to how I interact with the entrepreneurs, because I know what they're going through. That helps. And part of what I do as a board member that I found both interesting and useful is to be the bridge between the entrepreneur and the investors. Because indeed, there are a lot of problems that occur in most companies at some stage of their life between a conflict between the goals of the investor and the goals of the entrepreneur. If you have somebody that's a fair broker, or at least perceived to be by both sides, having experience on both sides, it really helps calm the waters and get the company back on track again and moving. So I think that's useful. So I'll leave it at that.
Good. Gayatri?
Yes. So this is a great question. When we are coming to invest in a company, the company has already earned its fair share of revenues, fair share of traction. So obviously, it's a great company, and we are looking to invest. There are obviously great cap table holders. Now, for us, it is very important if you're taking a board seat that we like the founder, because this is a different kind of a marriage. And I know this is a little bit shorter than the early stage investors, but we will be involved not only just with a check, but also enabling opportunities in the business development and bringing clients, customers, introductions. And sometimes when we invest, we also bring some of our large LPs, like some of the pension funds and others, come to invest with us. So it is important for us not only to like the founder, and I know we always talk about at the early stage, the investment always focusing on who are the founders, and at growth stage, it's all the numbers and matrix. But beside the number and matrix, we want to understand the ethical behavior of the founder, because we have such strong ESG and impact focus. We also want to make sure that the founder has the right vision, because obviously at our stage, we're looking for, if we get a 2x return, that's great compared to earlier stages. But we want to make sure that when we distribute those securities, and some of our LPs will continue to hold them post IPO, they continue to grow as a bigger companies. So there are a lot of challenges, but for us, it's very, very important. We like the founder, we like the mission. Also, the focus towards diversity is very, very important. What are not just the board, the executives, but also the products and services, and how they're looking at the market, the vision, and especially the impact space is growing right now. And what are the geographical expansion? So all those understanding is very needed, but also we want to understand that the founder has taken the company from here to there. What's they're going to do next to be the next big thing, not just take a corn, but continue with that success. But sometimes we have seen a lot of founders are also, we will stay where we are. We don't want to be a very high growth company, but those are mostly private equity fund investors are perfect for them compared to us. But yeah, I think founder investor fit is very important, not just in early stage, but also at growth and late stage as well.
Awesome. Yeah, no, it's good that you have the kind of bridge from the early stage to the late stage. It's good to see the life cycle, how investors get involved at the different life cycles of a company. So Adam, you just talked about the demands and kind of, the working relationship and how they're hard to navigate with founders, often, I would argue. So what types of expectations are you setting with the founders for both your involvement and their involvement in the relationship once you make that investment?
Mendoza Ventures wants to be aligned with our founders. We want our founders to have a sizable equity component. If they're going to work their tails off to build a great company and make a great return for the stakeholders, they need to have a big chunk of it. So there's that alignment with the way we think about it. We obviously want to have a decent percentage of the cap table as well, but we want the founders and key team members to be well rewarded and well compensated for all their hard work that they're putting in. So that's really important, that alignment of financial interests, the alignment of, working together it has to be collaborative. So it's not a straight line. There's ups and downs like anything else in life. And I think we'd be foolhardy to think otherwise. So in order to achieve that, how do you do that? I think, frequent feedback is really important. Don't let things, if you feel a certain way, let the founder know how you feel. I don't think we have that problem, but I mean, there's always room for improvement. We hope that our founders feel comfortable sharing with us how they're feeling about it. It's really stressful to run a startup. These people are under incredibly trying times to build a company from where we get involved, generally the seed stage. It's, they're not a well-oiled machine at this point. So I think having that constant collaboration, having the financial components that everyone feels good about makes the process happen, and then it's iterative. You evolve. There's no, I definitely read a lot of business books. There's a lot of great stuff out there, but it's iterative. There's no paradigm to how to do this. It's really, it's really kind of working with a person to get what works for that unique individual in that unique situation in that moment in time, to try to succeed at a lot of levels. So that's it's complicated, but you just got to work at it.
And John, do you have the same experience?
I tend to think that one of the things that if you're an operating person and you're on the board of another company, you default to thinking, man, if I was running this thing, I wouldn't be doing what this guy's doing. You have to suppress that because you made an investment in that team, and that's what you're going to ride with. You give your advice when asked for it. Boards actually have very little power. They can, the only thing that they can effectively do is essentially starve the company of money if it's a VC-backed board, or fire the CEO. That's about it. So it doesn't pay to kind of be a pain in the ass because it's not going to work. These are entrepreneurs that have a vision of what they want to do, and it's not going to necessarily be identically matched up with what you think there should be doing at any point in time. If they ask for advice, you should be there. But the best advice that I think, I try to do with boards that I'm on is to get them the right people when they need it and get them the right investors when they need it, but not to be a pest. If there is a letter that is sent out to the investors on, a status letter, that's a great opportunity to respond to that without being kind of in your face that I got some ideas that I want you to listen to. So being and for me, it's hard to believe, a somewhat passive board member. I've known Joe for a long time. But I think that works much better. And it should be, I think, what you should look for when you're looking for board members is that you don't want somebody who's an employee. You want a board member, and the board member needs to be held to some responsibilities to go help the company, not just to show up at a meeting and comment. So that's how I think about it.
Awesome. And Joe, what types of level of support do you provide, and how are you doing that most often?
Yeah, so I think the role of an angel investor / mentor is different than that
Absolutely.
of a VC. And even though the VCs say we're here to help and work together, there's a little, ideally there's more intimacy. I know I often talk to entrepreneurs, especially if I'm on a board. I don't want a sales pitch. I want to have a conversation. If things suck, tell me they suck. Because I have seen, and not to throw VCs under the bus, but there are there's a different dynamic when you're a venture investor. You often have LPs that are looking over your shoulder. You're in the process of raising a new fund. You don't want to write this thing off quite yet. You want to wait a little bit. And I'm exaggerating to some extent, but I just want the pure, transparent conversation. And I just had this with a company, called me up. He's in a panic. He had a term sheet that just got pulled. He's on the verge of going out of business. And instead of having all the conversation around what can I do to save my investment, I made the observation, I think you burned out. Let it go. Don't even, and if that's not true, push back, fight me, and I'll help you through a path. But his knee-jerk reaction, he had lost his mojo. And I said, look, don't, you got a life to live, flush it. I haven't heard back from him. I don't know if he can do it.
Still waiting to see how he's doing.
So, no, this was just yesterday. I had the conversation. So I don't know. And even there, I didn't tell him to. I said, if you still feel energized, then here's the path I would go on. But if you're doing it because that's what you think you should do, and your heart isn't in it, you're not like Elon Musk, who's never freaking going to give up. He's going to go to the end. If that's not who you are, then don't go there.
Yeah.
It won't be fun.
Yeah. And Gayatri, with your experience in not only late stage ventures, but also with diverse ventures led by diverse founders, what does your level of involvement look like? Is it the same as other panelists, different?
Yeah, so I so agree with Joe. We call ourselves activist investor, but even if we call ourselves that, I don't know how much activism we can do sometimes. Even being on the board, we have to really walk the fine line and nudge the founder what they need to do. What I can say is that we are a very new fund, and for us, the relationship starts even before we think about investment, because it's a long process. It's a large check. We basically start building the relationship long time ago, and then we work with at that time the company is already big. We have the chairman of the board. We have so many board members. We have multiple founders. Then different executive team members. So we tend to work with all of them, understand what is needed, and then it's a long process before even the investment is being made. But at the same time, sometimes you sit on the board and you're like, oh my God, this is going in such a different direction, and you want to bang your head, but you also want to be professional and be careful and walk the fine line. And sometimes you don't want to embarrass the founder also in front of everybody. Later on, maybe you nudge the founder in a different way and say, if you go in this direction, this is much better. This is the path. So it is as I said, how much we call ourselves as an activist investor, especially at our stage, it is, the founders are already like so big. They already have maybe developed a giant ego with all this valuation. So it's not easy. And sometimes we have to walk the fine line. But one thing I'm going to say is that I have found the founders who take feedbacks from investors, whether it's angel, VCs, and anybody, they're the best founders, because they know that the future is all about feedback and understanding and grow. And I understand like all feedbacks are not equal and all feedbacks are not great, but understanding and canceling the noise and understanding what to take out of that's what makes a great founder, because you have a long shelf life. You have to go post IPO, continue to build this company, and that's where you need to walk that fine line, like that stability of a great CEO. And I sometimes understand, like at a growth stage, sometimes most of the early stage founders, they're like, oh, this is the time when I should bring like a corporate CEO to run the show. Those are also various opportunities that people should look at, that when is the time to bring the right expertise in your team and say that, this is not for me, I'm going to go and do something else and build again something from scratch. But as investors, I always say we are more like backbenchers, because the frontline seat is taken by all the founders. But we just want to make sure as a facilitator, we are we are activating the right kind of heroes. Yeah. And especially who can champion the spaces and also bring us good returns.
Absolutely. And Gayatri, how, when it comes to the expertise levels or the needs of the founder, how are you identifying that? Are they straight up telling you? Are you asking them? Just walk us through kind of your process and different conversations you have around identifying the needs and which ones you should prioritize.
Yeah, so at a growth stage, I believe they already have so many things going on in their company. They already have all expertise, all needed. But sometimes what we can bring it to the table is making sure that the vision towards the future is right. And especially at this market where the public comms, where the valuations are in, I mean, we knew this was happening, but sometimes the founders want to still ride the wave of higher valuations, and this is where we come in to check the founder, like, okay, this is what you can do, this is what you should not do. And also understanding, like, as I said, like at the stage we are investing, the founders like, oh, we already know it, what needs to be done. But we also need to understand, like, where is the next phase? You already take the company from here to be unicorn or already unicorn, but where is the next phase for sustainability of this particular company post IPO? And that is where the vision should be. And we try to work with the founder in understanding. And the market is changing a lot. Today this is hot, tomorrow that is hot. Like fintech was hot 2 years ago, or even last year also. Now if you are talking about a fintech company, I'm just like, oh, is it a down round or what's the valuation? So there's like the investor mentality, and especially I'm talking about more from the standpoint of people who are more at the back and looking at the market. They're like, okay, especially the bigger side of the investment world, they always compare everything with public comp. And sometimes I don't think it's a good way to look at these companies. But again, our opportunistic way to see how the founders can be helpful and what areas we can enable them in geographic expansion, what are the opportunities of bringing out newer verticals and getting the feedback loop, and not burning a lot of money. Yeah, trying to be a little bit conservative, though I think a lot of VCs will look this in a very different way. But as I said, like at the end of the day, we can nudge, we cannot force a founder, we can help them to look at the things, but we can do up to so much. And that's why a good founder is someone who can take that feedback and understand what they need to do.
Awesome. And Joe, take us to the beginning, because you do a lot of angel investing. What are common needs or areas of expertise that you see, often from founders that you work with or mentor or invest in? What are the most common ones you see, obviously outside of capital? Which
You say expertise I see in the, you mean what are the needs of the founders?
Yes.
What skills do the founders have?
What needs do the founders have?
Boy, it's tough. We were talking earlier about biases and preconceived notions, but there's such a wide range of founders. I've invested in teenagers who haven't even incorporated yet and have no idea what they're doing. And I've invested in, third time, fourth time entrepreneurs, 10th time entrepreneurs like John.
You had to bring it up.
Well, you know what? But I don't want to be cavalier about it. Although it was probably well worth it, me rubbing his nose and that the money spent. So I tease.
I lost a lot more than
I
you
know. But that goes with the territory. Sorry, I'm changing your subject here. So there's no one. It really does depend. If we talk about first-time inexperienced entrepreneurs, then in that context, it's a little bit like the kindergarten teacher. They don't know anything. You got to teach them how to go to the bathroom. I mean, not how to go, where to go to the
bathroom. And they have to ask to go.
Sorry. But that doesn't make them any less. That's the other thing, is the lack of experience. And I see too many people who kind of look down their nose at someone who makes a dumb mistake or something. And having made my share, I try to do it in a supportive empathetic manner and very much chameleon-like. That's why I have no deep expertise. Sometimes they need help on building a team. Sometimes they need help on coming up with a term sheet. Sometimes they need help on splitting ways with a co-founder. Sometimes they need help on changing business model. So it's more recognizing where there's an issue, and a little bit like John said, bring in the experts. I'm not the expert, but recognizing, boy, you really better hire a CMO, or you really better get someone that understands such and such. You need a CTO. You can't do it yourself anymore. So I think it's more pattern recognition of recognizing areas where there's a need, rather than giving the answer, because I don't have the answer.
Got it. Adam, John?
Well, I just add, just to Joe's point, that Joe is networked like nobody else I know. He's been doing this for so long, and he's quite prolific in his investments. I mean, so he knows a lot of people, and that brings a lot of value to his companies that he's affiliates with. When in the same areas I talked about of knowing, you know, who's available as a good VP of sales who just left a company that maybe, you know, got acquired or something like that. So having an investor and board member that's particularly in this community in early stage is a very valuable thing to have. So I'd say your expertise is underrated by yourself.
By the way, I'd like to pick up on that, because one thing I talk to a lot of, this is more my VC friends. I say, you know, when you run a big VC fund, you have a team of analysts. You pay them $80,000 a year to go do stuff. I have $1 million a year analysts. They're people like John. You know,
Yes.
Right. I say, hey, John, can you help me with this? And, you know, the advice you get from 10 minutes of his time is way more than you're going to get from a lot of other people. But it's recognizing, making the right match.
And it's worth exactly what you pay for it. That's what I say, Joe.
I think my perspective on this is that all the stakeholders have to be very cognizant that, at least at the early stage, and even at the later stages, I mean, it's just not linear. You know, there's just not just whoosh. There's incredible volatility in companies that are even massive corporations that have humongous market caps are volatile today in the world. So you can only imagine like a 10-person startup and the beta, if you wanted to, if they ever track the beta, which there's no mark-to-market valuations, but it would be insane. So it would be a very high beta. So in that context, what do you do? How do you handle that? You really just have to be all hands on deck. Generally, these companies are resource constrained. They're not overflowing with cash. People are doing 3 or 4 jobs, and it's a lot. So how do you overcome that? You just, you know, you have to have great willpower, an ability to know what you don't know. Certainly you're doing multiple jobs, but if you're doing something that you just don't know the answer to, recognize you don't know the answer to, and find someone that can help you get that answer as efficiently and most cost effectively as possible. So build your team around people that are have skin in the game. I always like to ask people, you know, it's great to go grab a cup of coffee with someone and hear their thoughts, but they're going to care a lot more if they actually have some money in it. Anybody can tell you what to do over a nice cup of coffee. Oh, I had a great latte with this guy or gal. And do they really care to, you know, they're on to their next meeting and they might have skin in the game in that next meeting. And they're thinking more about that one than you. So get people to have skin in the game, and they're going to care a lot more. It just takes things to a much deeper level. So that would be my advice. When you're getting advice, knowing if they have skin in the game or not, or asking people to invest in you and saying, you know, I want you to be part of this cap table, is really, it takes it to another level. So that would be my advice. Get advice from people that have deep skin in the game.
Awesome. And John, can you share a story or an example of a time where you helped a portfolio company outside of providing capital and it went really well, and what you did that you believe made it really successful?
Can't think of one.
Not one.
It's I think I mentioned that it's almost the inverse. All my unicorn investments, I was not on the board and did not participate, which yields a result that says the ones that are most successful are the ones that I'm not active in.
Data.
So there you go. That's how.
Is it that you weren't active, or did you perceive that they were so skilled that those you said, holy shit, there's a
Active, yeah, active is normally the board, and it depends as to whether you're asked on the board or not. I can't control that. Well, my own companies I can, but even to the, I mean, I can't think of an instance, I guess. But when you were talking about the volatility of companies, a lot of times, very successful companies, you find out almost went out of business. Well, in DECA, which I was an investor in, and they wound up selling for $1 billion plus to Oracle. And so that was very nice. But Steve Papa was the CEO, local company, and I knew Steve. I'd see him at events and stuff like that, and we'd shoot the shit and stuff like that. But I really wasn't active in the company because I thought they got a great CEO. They're moving ahead. So he wound up giving a speech at the Royal Sonesta in Cambridge, and about after the acquisition, about what he was going to be seeing in the future, et cetera. So I grabbed him afterwards and said, Steve, I just want to thank you and congratulate you on your, on the sale of the company. I said, you did a great job. He says, John, did you know we almost went out of business twice? There's no visibility in private companies, even for the investors. The board sees a lot of stuff and the top tier investors. But if you're an angel investor, what other story to that? I've been in that company too. Exactly, where they ran out of money. The board announced that they have no cash, zero. The board actually wrote checks at the board meeting because you got tax liabilities that essentially go. But there was one other, to the point on communication of private companies to their investors, the early investors, the angel investors. There was a company called Peer Transfer here in Boston, which I was an investor in. And two Spanish guys from MIT decided that there was an opportunity in payments because their parents were paying tuition here and getting screwed by the banks on money transfer. And then the inverse was also true. People who were working here from Spain were sending money back to their parents and getting screwed. So they said, it's the same money. We can build a business around that and lower the fees. Sounded like a great idea. Invested in the company. 5 years go by, never heard from them again. Not an email, nothing. They're from Spain. I probably lost the money. I talked to my friends, and one other guy that actually made an investment, and he didn't know anything either. I said, well, I think I'm going to write it off because I can't even find these guys. That was Flywire. They changed the name to Flywire.
In my head, I was like, that sounds like Flywire.
It was. So I was ready literally to write it off because I didn't get any communications from them. And the first communications that I got was a telephone call from Bain Capital and saying, Mr. Landry, we would like to buy your stock. I said, wow. In what company? And they said, Flywire. I said, I'd love to sell it, but I don't own any stock in Flywire. He says, well, it used to be known as Peer Transfer. And I almost fell off my chair because I was thinking of writing it off for tax purposes. So that turned out to, but point is, angel investors don't get a lot of communications. And sometimes you wind up perhaps making better decisions. I guess what I'm saying is if you're on the board, you get a lot more visibility into the companies. But if you're only an investor, you don't see very much. And there's frankly companies that I think I've forgotten that I made investments in. But as time progresses, that will be even more the case, just by natural aging processes. So, okay, that's that.
Yeah, no, that was great. 2 stories.
Yes.
Gayatri, do you have an example of a time you provided guidance and it went really well and what you think contributed to that?
I don't have a story because we are still too early. And
Gotcha.
one of the company that I sit on board where we have not invested, but we are thinking of investing. It is just from a pure, opportunity way where we are like, okay, this is a market that I want to learn about. It's an EV company. And frankly speaking, it's the most capital intensive space. It's backed by US Department of Energy and a couple of others. And I'm still learning at that space. I feel like I told the founder, you need to be much more like Elon Musk type, where you're like ready to go till the end and, and be that savvy, because that's another thing. In order to raise money, you need to be very likable. That's like a very, very important quality. But yeah, I mean, I'm hoping they can take the company to the next level. They're in their Series A, Series B growth stage. They're talking to the right people. But again, I feel like I'm not an expert in that area, and I sit on the board of the company for my own benefit, just to learn about that space. And I think that space is going to grow so crazy. But uh, from my standpoint, I try to understand the little bit of the behavioral aspect that goes in effect, the part of storytelling, that how do you attract somebody, especially by somebody, I mean investors, to give their time and energy. And these investors like Joe, John, Adam, and I think as VCs, we are basically different animals. We are bound by our LPs or things, but especially like John and Joe, they're investing their own money. If you can get their time and energy, and they're backing you with that, um, beside money, I think that's the best thing that can happen to any founders. And I think the early stage phase, especially from like angel to series A, B, those are like the oxygen years of the founders. You're pivoting, you're doing so many things. So for us, I mean, when we come, it's already pretty late stage, where you're thinking in a very different perspective. But I feel like understanding from the founder's perspective, like understanding like who to bring on board, the founder investor feed, but also, taking that advice from the angel investors, I think, and from the early stage investors. I think this is so important, because we have seen so many companies pivot by the time they're like post-seed Series A. And that's like, this is something I want to like highlight and emphasize, that post-seed to Series A, it's going to make you decide whether you're going to be a venture-backed company or like a small business. And that is like so important. And it is important for the founders also to realize that what makes you a high growth business. So surrounding yourself with the right kind of, not just VCs because we are giving you a check, we sit on the board, but having those early stage investors being with you, giving you the right advice, I think it's so important.
Absolutely. Adam or Joe, do either of you have a story or an example of when you helped a portfolio company and it ended up the guidance was really helpful and turned out well for them? Or Joe, do you have too many?
Sure. No, we've made about 13 investments now. This has been over the last 5+ years. We typically engage a company at the early seed stage. So the companies are typically under $1 million in revenue, some cases under $500,000 in revenue. The companies have, a clean cap table. We didn't really talk about that much here, but you got to make your company investable to other people. So that's obviously extremely important. We generally write checks in a convertible note or a safe note environment. I assume everyone here in this room and on the call is familiar with that stuff, but that's where a lot of you're basically not valuing the company. You're pushing the valuation downstream until there's more certainty in the asset. We'll write checks for like $500,000. There'll be a valuation cap, which is another term that's important to this discussion, of usually anywhere between $7 and $10 million, maybe a little less even sometimes. And the company is typically less than 10 people, clean cap table. They have a product in market, so we don't invest in
cap table.
a clean cap table is one that we can, and Mendoza Ventures can enable us to get 5 to 10% of the company.
I thought there was one without John or Joe.
Yeah. Yeah. No, we recognize that we want to have the ability to have we recognize we want great angel investors. So, that's really important. I talked about skin in the game. So you want a lot of these founders to affiliate with great guys like you that, have incredible knowledge, incredible networks, and the ability to have, are obviously accredited investors and can take some sizable positions. So that's important to us. We want to get on the boards of these companies. We want to, it's called de-risking, there's risk in these assets, and we want to de-risk it. Every time you take a little risk out of a company, it potentially becomes more valuable. And that is in all areas of the company. You'll see us make these $500,000 investments. The notes will generally be about $2 million to, in that range. Let's say for a convertible, we'll take up $500,000 of it, and then the other 1.5. Some will be our LPs that write individual checks. We'll put together some syndicates as well through our relationships, and that'll be the beginning stages for the first institutional tranche of money that these founders will take outside of their personal capital and then friends and family round. So that's where we enter. To get there is a lot of hard work. You have to have proved a lot to have an institution take a position in you. You have to have product market fit. You have to have a product that's beginning to be scalable. You have to have the formation of a decent team. So there's a lot that obviously goes into that, but getting that, some significant angels like John and Joe on as well as then the venture capital really can propel your company to that next stage where it's an evolution. It's part of the life cycle.
Yeah, you had asked about where value was contributed, and maybe just an issue of being not self-aware, but I've had some cases where an entrepreneur had come up to me 5 or 10 years after founding and say, just thank me profusely for some meeting or piece of advice that I gave that was transformational. And I don't even remember it happened. And I've had other cases where I thought I was the reason they did something. I mean, I remember the meeting and the passion, the discussion and the fighting. And it's like that never happened. So sometimes we think we provide value and we don't, or at least it's not perceived. And other times you don't even know you did it. And they're thanking you for something you didn't even know. Either you don't know you did or you didn't know it was valuable. So
that value is associated by the stage of the company too. Joe and I are both very early stage. And at that stage of the company, product market fit is really the critical thing. Do you have something that people want? Is it built on the right technology? Is it have enough degree of uniqueness and scarcity that it's going to have value? And guiding people through that process is the thing that I think I have the most expertise in. And so when I sign up for a board, board members get stock options. I've done very well with those companies. But the deal is for the most part, I'll say, I'm going to do this for 2 or 3 years, and then you're going to get somebody to replace me. Because that's when you're hopefully shifting from an early stage company to a mid stage company. And at that point, the expertise you need is in sales and marketing predominantly, customer support, all the things that allow you to start scaling from the product or product line that you've built. Somebody else can do that better than me, and you should go get them. When you're going to late stage, that changes again. You need people that are operating people that understand how to scale a business from an operations point of view. Certainly not me. It's probably not the guy that you got when you were in the sales and marketing mid-stage. So you should think about your board as not having a permanent relationship, and the board should understand, the board members should understand that they're there for a purpose at this stage that might not be going forward what you want. And so I bail out. How do you get to 43 boards? You don't stay on them. And by that time, you've got a nice position in hopefully from those stock options in a very early stage company that's now on its way, and it's going to work out, in 10 years. So look for those board members and make sure that you're getting the guys that you need at that stage of the company that you're in right now.
Awesome. And a kind of a big theme that I'm pulling away from our conversation is just kind of the natural ups and downs of entrepreneurship and the highs and the lows. So I want to talk about the lows. John, how do you help entrepreneurs recover from those lows? You can do everything right and still fail. And what does that look like, that recovery process?
I think failure is overrated a lot. I mean, every, VC will give you a speech about, we think, we like risks and all that. They don't like failures. People don't like failures. Luckily, I've had one myself, so I've understood that. As I said to Joe, we sold it. But what was the problem there? It was a co-founder relationship. And I'll just riff on this for a second. Historically, I've been a big believer in co-founders because I had co-founders that my friend Bob, that we did 4 companies with. I was typically chairman. He was CEO and president. I was CTO. So the CTO reports to the CEO and the CEO reports to the chairman. So we had what we called the MC Escher organizational chart. It looked like the stairs that go on forever. But that's because we were really good friends and really understood each other. And the more we did this, it actually worked. So we understood what the dividing lines between us were and where we specialized. I don't recommend that to everyone. And I don't, and if I was trying to replicate that pattern at Adesso. But if you have a co-founder that doesn't agree after you've hired him with somebody who is who you wind up not respecting, et cetera, the company can go out of business based upon co-founder relationships. So picking a co-founder, I don't even recommend anymore. I believe if you look at the history of the large companies, they're not co-founder based. They are solo founder based. Gates, Ellison, only Google actually pulled off being a large company with co-founders. What you want is a solo founder who knows how to hire somebody who's a co-founder, but not with equal responsibility or equal interest in the company. So in my opinion, what happened to that company that failed, I still think phenomenal concept, actually blew up because of the co-founder relationship between me and this other guy. So it's hard. To this day, you hear me talk about this. You don't like to fail, but you go out and do it again. And luckily, I've been able to do that. But so I have, to your point, some idea of what a failing founder is going through. Yeah. And try to prevent it from happening before it becomes that. And the co-founder relationship is a much more important relationship than I think people actually realize.
Adam?
Failure is part of life. Difficult, but just part of the human condition. So it pervades in startup world, probably more than other endeavors. How you overcome that and handle that is a lot of strong willpower, strong stomach, and you learn from it. I mean, I think everyone takes away some of their best learning experiences from their failure, and hopefully don't repeat that on an ongoing basis. We know we're not going to be perfect doing this. I don't think our investors think we're going to be perfect as partners in a venture capital firm. We don't think we're going to be perfect, but we believe that we can strive to lessen the probability of failure. And when they do fail, no one feels good about it. It stinks. I mean, you know, there's no doubt about it. It's
Not a fun experience.
It's not fun to lose. It's not fun to lose. No one does. We all like to win all the time. But that's not realistic. It's not a perfect world. We're not perfect. But I think if you are able to learn from those moments, push forward. I think our culture in America, compared to some other cultures, is a risk-taking culture more than some other cultures that exist on a global scale. And I think we honor and respect people that fail. I know from other cultures, you're really kind of you're put down for failure. I think people in our country get second, third, fourth, fifth, sixth chances, which I think is outstanding and promotes growth and obviously promotes business growth and promotes personal growth. So we have that philosophy. We try to obviously not fail, but we are going to. And when we get to that moment, we do the best we can to move on and pick up the pieces and put our energy into having the next thing succeed. And I think that's all we can do as people.
Do you want to go, Joe? I was going to give it to Gayatri. Do you want to go?
Yeah, I think what flashes through my mind is the title of this session, something about turning horses into unicorns or something like that. And in a way, I almost think that's the wrong way to think about things. I always encourage people to just know who you are. You know, if you're a great chef, that doesn't mean you should start McDonald's. You know, you can do one restaurant, you can do two restaurants. Sometimes they can't even do a second one. But just know who you are. And there's nothing wrong with having a business that might only be doing 2 million a year or 5 million or 10 million or 20 million. But if you have a business that's only going to do 10 million, don't go raise 5 million in venture capital. Because now your expectations, the VC's writing the $5 million check, can only make money if you become a $100 million company or more. And so it isn't, how can I put it, money and size is not success. Success is doing well at what it is you have targeted. I think, you know, John pointed out failing is not fun, but one great way to fail is for me to become a trapeze artist. Guaranteed failure. You know, so why try? You know,
Yeah, that was great. Gayatri, your thoughts?
Oh my God, I have so much to say in this. So
Say it all.
It's like there are so many tools where you can see things that this is going to fail. I think what John said, the very first failure step is the founder, like co-founders coming together. If the mix and jam is not happening, and there are so many things that keeps on building on it. The product, maybe you are starting the company in a space which is already too crowded. There's already too many incumbents. You're building a product in a space which may not be too sexy, and you're very bad in storytelling. And so this is also like the qualities of the founders, how you're telling your stories. There's so many important factors, and this is something as an investor we need to understand. Things that you can, like the word molding a horse into a unicorn, though we want to be, you know, careful with not to do any harm to the animal, but there are some skills that you can teach, and they can learn, and there are some skills you cannot learn. You know, there are some skills you can bring an outsider, outsource it, but there's some skills that are very, very inherent, and we as investors need to have that capability to find out what are the things that we are risking or de-risking by investing in this founder, and things that they can bring it and things they cannot. So few things, like especially from the founder perspective, I want to say, and especially looking at the audience, it's like you need to understand there is no plan B when you're starting a company. If you are passionate about this space, then only do it. You know, you have to make sure you are ready to ride and die with this company. because we as VCs are ready to ride and die with you. Once you write a check, we are basically into it till the end. So for founders, it's so important to understand what they can do, what they cannot do, and then as you grow the company, there's operational risk. And that's something, even if you are such a great founder, you can do so much. That is something very, very difficult to control. And in those times and in those areas, it's better to bring outside expertise. And obviously, you never have control over your market, as much as we all want to time the market and understand the market, and we think as we are expert, there's so much that goes in effect. And sometimes we feel like, oh my god, this is a great founder, we invested in this and this is great, and we ended up like that company did not do well. One of my partners is an early stage investor in, or not even early, like angel investor in Zipline. Now Zipline is a big unicorn. When we invested, we didn't even think about it. Same with another gaming company. It's one of the biggest gaming company in the world. So for us, it's like you sometimes don't know also. And this is another thing. The founders also grow with the company. They learn so much and they learn to step up and be who they need to be. Few things I want to highlight. The big recipe of failure is, especially for first time founders, is that they bring an advisor or they bring an investor who takes 70% of the company, 50% of the company, 60% of the company. And I want to tell them, anybody who want to start a startup, go hang around in all this startup Boston, go and hang around in the ecosystem, learn as much as you can, because you don't want to give 70%, 80% leverage to an investor, because it will be very difficult to scale that company unless you want to become a small business or something like that. So, and then there's like, coming back to this point, is like, at what point do you want to bring VC money? Because I always see early stage early stage companies, they want to, even before talking to an angel, they're straight away maybe talking to Mendoza Ventures or to us. And that is the time they should be talking to, John and Joe. So at what point you talk to the VCs? Because the moment we invest, we are basically breathing down your neck, like how the return is going to come, how that money is going to pan out. And also understanding that, the market, the understanding, like the fundraising landscape is also very important. I hear from founders, oh, now I'm going to raise, my next round will be a $50 million valuation. And they're talking about Series A or 100 million. And some people at seed stage, they're talking about $50-100 million valuation. And I think the moment you talk like that, the investors is already like making a assumption and understanding that you have no idea about what is going on in the market. So it is very important that you understand the fundraising landscape. It is also very important that you keep your valuation not astronomically high, because that's another expectation you're setting in to yourself. And I just want to give a little bit of perspective, considering the crowd is like, when you're going to Series A, your chances are you might be having 100K MRR or something, and the rounds will be more like $3 to $10 million round, and valuation 10 to 30 million, and it's like take 5 or 10 million plus minus. But by the seed stage, and you're going to the Series A, you're giving 10% of your company. And if you can stay in that, that's wonderful. But most of the people and most of these rounds require up to 20% dilution, and you should try to avoid at least more than 25% of that. And by the time you reach Series A, you have given up 35% of the equity in your company, which is not atypical. But most companies, they end up giving away ranging from 20 to 50%, in this round of funding. So understanding how much you should give, how much you should not, having a control of the company is also important for the founders. And by the time you reach Series B, it's like almost 3 million, 5 million ARR you're targeting. If it's 5 million, it's great. Normally 3 million or something like that, it's another 10 to 25 million dollar round with valuation of 25 to 100 million. And then by the time you go to Series C, Series D, it's a 10 million ARR or some around that round, and the size of the round maybe 25 million plus. The valuation is above 75 million. So it's an interesting phase, and understanding these nuances, I think, for founders is very, very important, because these are part of your storytelling. These are part of your milestones and how much you can grow, how much you can build. And I think it's a lot of learning. for the founders, and there are um, recipes for success. We are living in an internet age. You have so much of information. Learn those information and make sure you tend not to fail. And I personally believe you basically fail the day you quit. And as a founder, you never quit. You keep pushing, and that should be your motivation, because
Yeah.
you're doing this because you're passionate about this space and you
Yep.
want to bring a change.
Absolutely. Yeah. And thank you so much. In the interest of time, I want to have everyone be able to ask questions and whatnot. So I will turn it over to the Startup Boston folks.
Yes. So just before we jump into any Q&A, so anyone who's still online listening to this session, anyone in the room, the next sessions will be starting in about 7 or 8 minutes. In this room, we'll be continuing with the investor track, focusing on investing 101 for new angels and new firms that are popping up. And then in the district hall area, we're going to continue with the marketing side, where we're talking about how can you make your product go viral. But we do, if the panel is okay with it, for another maybe 5 minutes or so, to take a few questions from the crowd here, or we have a few questions that came in online as well. We just want to be mindful of the other panels that will be coming up as well.
Yep.
Awesome. So let me start with the room. Does anyone in the room have any questions for the panel? Yeah. Why don't you take the microphone here? Thank you.
Hi, my name is Rachel. You guys shared, specifically Adam shared, how useful it is to have, angels that put some skin in the game. The advice matters. But then how do you balance communicating with them so it doesn't become like a maintenance nightmare where they expect an email every month and then they all write back to you? How do you manage that?
I would actively try to recruit people that understand your business. Clearly, if you're in the medical device area or the biotech area, go out and recruit people from Novartis, Amgen, Pfizer. Go out and recruit people that will be LP angels that really understand that. So when you go in and pitch them, they're going to be an accredited investor. They're an executive VP at Pfizer or Medtronic or Novartis, and you get them. You figure out that you want them on the cap table, because that's something you're in that business. They're obviously a multi-billion-dollar market cap, but you go out and meet these men and women that are in these roles. That will mitigate the amount of communication you need, because when you're pitching them, they know your business. Or as a pretty good, 25, 30 years experience in the health services industry, which you would be in at this time at that. So don't just go after a rich person that's writing checks, and writes 50, 100, 200 checks a year, just throwing out money willy-nilly. Go after people that really would understand your business, executive VP, senior VP level, and that will dampen down the transparency you need to provide. So pinpoint who you want to attack as an investor. And the gist of this is, go after people that you want on your cap table. Your point is well taken. You don't want people on your cap table that are gonna, they give you money, but they're just annoying you. So that would be my advice.
I'd just say, as far as communicating, which I think was your question, the entrepreneur should be doing, in my opinion, as I did, an annual investor day, and you bring your executives, you talk about the plan, you talk about what's going on, and see if you can get more money while you're there. But that's a very effective way, and I think a newsletter is also very good, is keeping that contact going, not like Peer Transfer did, which I never heard from.
So
but maybe there's a sign there.
Another question.
Well, we are running short.
I think regular communication is critical, and don't think of it as something that the pain in the ass investor requires. The exercise you have to go through, especially if you think of it as a newsletter.
Yeah, sure.
You're just informing people. You're not pitching them. I hate it. There's some entrepreneurs, they communicate when they just close a big order, And when I can't meet payroll. And nothing else in between. Your comment about Firewire, whatever, you never even heard from them.
Yeah.
You could have probably been very helpful to that company had you got a monthly or at least a quarterly little thing with 5 bullets.
Yeah.
We're now doing this, we're doing this, here's how many customers we have, here's our revenue. Oh, by the way, we changed the name of the company.
Right.
Yeah.
So we are running short on time. So I think we do have a good amount of questions coming in. I'm sure other people in the crowd have questions. So I guess what's the best way to get in contact with anyone here, whether it's to you personally or to your team or to your firm, for people to kind of follow up with questions they might have after this session?
For me, I guess email is probably I don't know if they have it or give it.
We do have it. We don't usually share it. We're happy to share it if we have the permission to. We have everyone's LinkedIn as well. So whatever works best.
Pretty open to any means of communication. My LinkedIn profile is out there. It has, I think I've even attached my mobile phone to it, and obviously my email. So those are pretty, that's out there.
I'm the moderator.
You can send an email to john@johnlandry.com. It's redundant. I have 160,000 unreads right now. So all I can say is good luck. Normally, I mean, if it's a question, that's fine. I think most people don't respond well to getting a pitch over email. Somehow you want to get an introduction, etc. Send me an email and we'll see what happens.
I'm just the moderator, but you can reach out to me on LinkedIn if you want. I'll talk to anyone. Gayatri?
Yeah, please reach out to me on LinkedIn. And I think in this panel, I'm the last person you'll be reaching out to. So I think your first point of contact should be John, Joe, and then Adam. And then, if you need any help or anything, happy to make any introductions. And if you're at late stage and doing something great, please reach out. Always looking for great companies to invest. Yes.
Awesome. Thank you, guys.
I'm going to just add one thing. Your best way of communicating with somebody is like at events like this. After the session, grab me or grab Joe or something, or show up at something that your angel investors go to and entrepreneurs go to. The networking of organizations like Mass Technology Council, right where we are here. When you have events, those are the best times to actually grab somebody and either ask them questions or start looking for, advice on starting your company or raising money, etc.
I would stress the importance of asking. You get nothing if you don't ask. Use your network to pinpoint who you want to talk to, who's going to make your firm or make your life situation better, and get all the people that are advocates for you and ask them to help you and ask them for intros to people that can amplify you in the world, and ask and ask and ask and ask. This is just it's a salesmanship game. You have to sell yourself, sell your business. You've got to do whatever you have to do. And obviously do the best things with the best ROI and time ROI to get you to accomplish your goals. So bring people that care about you into it, bring people that you think would want to care about you into it, and ask them for help and ask them for introductions, and just keep asking. Because you do get that random phone call in life. We've all had it, or email that's just, changes your life, but they don't, that's probably came from all the hard work you did in the back end, so just keep asking.
We are going to make a quick transition to the next panel.